So Haley, about this loan estimate, it looks super official, like the kind of document that I'd sign away my firstborn child for. So can you help me make sense of this before I completely panic?
Absolutely. I'd be happy to go over it with you. Let's sit down together. We're going to go page by page and you'll see that you don't need to panic. So this is page 1. Your loan estimate will have 3 pages. This first page, you can think of it like a snapshot. It's going to kind of give you a high level view of what your loan is like and what type of loan you're getting. So let's take a look at this, see what questions you have for me. You'll see right here, this is your purchase price and then your loan amount. Is this about what you were expecting?
Is this the right loan amount? Or did I accidentally buy 2 houses? Yes, that looks right. Does this include my monthly principal and interest?
So yes, we will find that down here in your monthly payment section. So you'll see right here, your estimated monthly payment is $1,050. And in this bigger box, you'll see that how it's kind of broken out. First, you have your principal and interest section of $761. Then you have some mortgage insurance of $82. And then your escrows. We've talked about your escrows being your property taxes and your homeowner's insurance.
Right.
And this mortgage insurance is because you're putting less than 20% down.
What number on here is my estimated closing cost amount?
Great question. So you'll see here where it says costs at closing. The number one thing that makes borrowers panic is that they think that they owe $8,000 plus this $16,000. And I agree, it can be kind of confusing. However, this line right here is showing your total closing costs, period. This line right here is showing your cash to close, period. Meaning this is going to be your closing costs plus any remaining down payment that you are due at closing. So the only number that you will have to bring to the closing table on closing day is this $16,000 number. Is that about what you were expecting and what you're prepared for?
Yes. Do I have enough cash to close? Wait, this says cash to close. Does that mean I need to bring cash?
Please do not bring cash. What we'll do through the loan process is verify that you have $16,000 in the bank that's been made from either your job or a gift from a family member or just your typical savings, no large cash deposits. Cash is very hard to use in a mortgage loan. And then most states have requirements on how to bring this money to the closing table. Most attorneys or title companies require it to be a wire. So we just went over page 1. That was like your snapshot. Now we're going to go to page 2, which is going to be a detailed cost breakdown of every single closing cost that you're going to have to bring to the closing table, all right?
Okay.
So let's go line by line, shall we? All right, so we're going to start with your loan costs. The first section is section A, origination charges. This is any lender related fee. So it's going to be any points needed to buy your interest rate down lower. It's going to be any kind of application or underwriting fee that your lender may charge you, all right?
That's a lot of fees. Are you sure that they're not for the office snack supply?
This main fee is going to be the main difference between lenders across the board. All the rest of these fees are going to be pretty much apples to apples no matter what lender you choose. Section B is going to be services you cannot shop for.
So wait, what does this mean that I cannot shop for them?
So in the buying process, you're allowed to shop mortgage lenders, meaning you can choose which mortgage company you want to go with based on who has the best interest rate, who has the best customer service, things like that. However, once you've chosen that loan officer, there's going to be these charges called services you can't shop for because those are now chosen by the lender that you've chosen. Things like the appraisal, you as the buyer cannot choose who appraises the house. We technically as the lender have to even choose a third-party company to ensure that everything is done without any kind of influence on that property value. Credit report fees, the flood cert fees, these are all third-party services that the lender has chosen to do business with, and therefore you can't pick those third-party servicers, but you have chosen them because you've chosen that lender.
Oh, okay, that makes sense.
So section A is going to be lender fees. Section B is going to be any third-party orders that lender is going to need. So these are services that you can technically shop for. It's going to be things like what closing attorney you want to use, who you want to, inspect your home for pest inspections or survey your property lines. Those are all things that you as the buyer have the power to choose. And then you'll see their fees accordingly. So when you see these title fees, those are all fees that closing attorney or title company has charged to do the loan. So they charge this for things like doing a title search on the home, meaning they're checking what that property ownership history has looked like. Lender's title policy, so that's going to be an insurance policy that protects the lender if there are any kind of claims on the ownership of that property later down the line. Let's say that Sue owned the land, but Sam sold it to someone else even though he didn't have the right to sell it. That's when these title policies kick in to bring some lawyers into the game and to settle out who owns what and at how much cost. And then settlement agent fee is just that attorney's fee to do that title search. Same thing with the title search fee.
Wait, this is a lot of fees and a lot of middlemen involved. Can we cut some of these out? Is that possible?
Great question. That is a lot of fees, and there are a lot of people involved in the mortgage transaction. You have to remember that this is a transaction controlled by a lot of big hands, meaning the government heavily regulates everything involved in the mortgage process. And that's just too much for one person to do themselves. So we've got closing attorneys in their lane, we've got appraisers in their lane, and then of course the government will be charging some fees and costs to do the loan itself. And I, as the lender, cannot control any of that, unfortunately. My job is some of those loan costs, and I do everything I can to make it as low as possible for you as the buyer. But outside of that, the fees are what they are, and we just can't control them. What we can do is work together with your realtor, see if we can get the seller to cover some of those costs for you. We can maybe negotiate that. All right, so now we're on to this side of the cost breakdown. We've got some things called taxes and government fees. These are just fees that the government charges based on loan amount and purchase price to do the loan. Gotta love taxes, right? Next section is prepaids. Homeowners insurance premium. That first year of homeowners insurance gets collected at closing to ensure that there is proper coverage on the house. This is part of your closing costs. So later in the process, when you go to shop your homeowners insurance, this number can be subject to change because it kind of all depends on what policy you choose. So it could go up or down, and if you shop a really good rate, maybe that number could go down, and that would also affect your monthly mortgage payment. And then same thing with prepaid interest. So now mortgage interest gets paid as kind of a daily rate between the day that you close and then the last day of the month. And this allows you to then skip that first month and make your first mortgage payment the following month. So here you'll see that we've got 15 days left in the month between your closing date and the end of the month. And so that's why you now have that $262 fee. All right. Section G is your initial escrow payment. Because we are escrowing your taxes and insurance, reminder that escrow accounts are kind of like a savings account for your insurance and taxes. We have to set up that savings account, and we have to have enough money in there up front so that then next year when those bills come due, there's enough money to pay your homeowner's insurance year 2 premium and then your property taxes for the next year. So that's what these couple of months are doing, is setting up that buffer so that then 2 months from now when you make your first mortgage payment, every single month after that, the amount of money going into it will be enough to cover next year's bills. And then we have these other fees. This is where your owner's title policy comes into play. Just like with the lender's title policy fee right here, this policy will go into protecting you. So if Sam sold Sue's property and then now you're in trouble and trying to figure out how to keep ownership of your house, or let's say that Jerry next door is encroaching on your property line, your title policy can kick in to protect your ownership rights to the house and all of the property therein. All right. And then all of these together, you've got your total closing costs adding up all the sections. And then if we had any lender credits in the deal, it would be there subtracting directly from your closing costs. Okay, so this last section is calculating your cash to close. So that $16,000 number we saw on the snapshot of page 1 is also reflecting here. And this little box is going to showing you what all goes into that number. First, we have your total closing costs, and then we have your down payment. You're putting 10% down, so that's $18,000. And then this $10,000 deposit that you put as earnest money at the beginning of the contract purchase, that's going towards a credit for you at closing. So now add those up, subtract out your credits, you've got this final number. But wait, if you have an FHA loan, scratch that and pay attention to this instead. So for an FHA loan estimate, we have to remember that for FHA loans, we have something called a mortgage insurance premium. This is a 1.75 fee that gets charged up front to be able to do this loan program. But the great thing about it is that it can be added to your loan amount. So it's great. However, it kind of makes some of these numbers look a little bit off because of how these numbers typically flow and calculate on this worksheet. So you'll see here, down payment funds from borrowers, that's supposed to be 3.5% of the purchase price, but what it actually is showing this. I'm gonna bring page 1 back into play. And this is an FHA loan estimate with our purchase price of $383 and this loan amount of $376,843. So this loan amount right here is showing your base loan amount, which is going to be 96.5% of that purchase price, plus the 1.75 fee. And therefore, that down payment number is going to be $383 minus this total loan amount, which is why it looks a little bit short right here of your down payment. Again, this is kind of just a snapshot. It's not really explaining the whole picture right here in this one line item, but just know you've got your total closing costs that include that mortgage insurance premium, and then you've got your down payment with that mortgage insurance premium now subtracted out of it, your deposit, and then you've got your cash to close here. So it all balances out. It just looks a little wonky.
Wow, that's a lot of information. Are we almost done?
We are close to being done. There is one more page.
What?
Okay, this one's short and sweet. This is just some additional information about the loan. It's just going to show you some numbers on your total interest being paid, what your APR is.
What's APR?
APR stands for annual percentage rate. That's basically just going to show you your interest rate plus closing costs as a number over the total loan. So kind of what this number does is if you are looking at a loan estimate from 3 different lenders and your base interest rate is the same across all those lenders, take a peek at the APR, see whose is highest. Whoever has the highest APR usually has the highest fees. Okay?
Oh. So what happens if I'm late a day or 2 paying my mortgage?
So that's a great question. It depends on what you mean by late. So most mortgages are due on the 1st of the month. However, you typically have a grace period between the 1st and let's say the 15th. That exact date depends on your servicer, so don't quote me on that. But usually you have that grace period to have that payment come out of your bank account and pay your mortgage. So the 1st through the 15th, thereabouts, you're usually good and you're not going to get charged any kind of fees. Now, usually servicers will, after that date, have a late charge associated if you pay between the 15th and after, and you just want to watch out for that. If you're having a hard time figuring out where to send your mortgage payment, call me and we'll get connected. I can connect you with your servicer and see where that payment's supposed to go to make sure that we don't hit those late fees.
Okay.
All right, so does everything look good to you? Have we answered all your questions today? If so, we're gonna sign right here.
Everything looks great.